Good morning. My name's Paul Nicol, Managing Partner of GFM Wealth Advisory. Today's podcast is on a recent addition to GFM's approved investments, the Perennial Strategic Natural Resources Trust. We're fortunate enough to have Sam Berridge, Portfolio Manager, and Ewan Galloway, Deputy Portfolio Manager of the Perennial Strategic Natural Resources Trust, joining us to discuss the fund. Also joining us today is Amelia Paullo, who is one of GFM's senior financial advisors. Let's get into the chat. Before we get underway, today's podcast is general in nature and not specific to your circumstances and should not be considered personal advice. Welcome, everybody. Sam and Ewan, let me start with you guys explaining your background and why you set up the Perennial Strategic Natural Resources Trust.
I have a background in geology and, I got sick of working away at mine sites. I think I finished my geology career over in West Africa where I got malaria 3 times and shot at once and came to the conclusion going home at the end of the day was desirable. Yeah. So after a bit of study, became a mining analyst and then joined Perennial. And in setting up the fund, we saw the opportunity in that the commodities sector had been starved of capital for a decade or more since the commodity boom of the 2000s, and just looking at more and more opportunities popping up in that space. And based on an investment record we that sort of developed within the other products, we've started this product and it's done very well.
Terrific. And you, Ewan?
Well, my story is less exciting than Sam's, but I spent the first 5.5 years of my career doing healthcare investment banking in London, so equally wasn't getting to go home as much. Moved to Australia in 2016 and then joined Perennial. Sort of was fortunate enough to start working on energy and large cap resources and sort of got the bug and then hooked up with Sam and haven't looked back ever since.
Terrific. So what is the investment universe of the fund? How do you go about constructing the portfolio?
So we're focused on commodities and businesses that facilitate the activity of commodity production. And so our investment universe spans from the physical commodities themselves, which are generally less volatile than the equities, but we like that because the whole purpose of this fund is to provide investors with all the upside that commodities offer, but with reduced volatility, or as much as possible reduced volatility. So our investments universe spans from the physical commodities through to the smaller developers, right up to the multi-billion dollar commodity producers.
And Ewan, typically how many positions would you have in the fund?
Normally we say the range is around 20 to 70, but at the moment I think we're probably averaging around 55.
Terrific.
Yeah. And on the back of that, do you mind explaining the investment process of the fund?
Yeah, so investing or making money out of our commodity equities, the core challenge is getting the commodity allocations correct, because it's very difficult for a mining or an energy company to outperform whilst the product they're producing is falling in price. So you need to get that commodity allocation correct, and that's a big part of it and probably 70% of the challenge. We do a huge amount of macroeconomic, microeconomic, and commodity-specific research to inform our commodity allocations. And once we've worked out how much gold, how much copper, how much rare earths, how much lithium, oil, gas, etc. that we want, we then populate those commodities that we like with equity, a mixture of equity exposures and commodity exposures. Always trying to make sure that risk and reward sits firmly in investors' favour.
Yeah, very good. And in terms of the macroeconomic environment, with everything changing and this constant change in the world, how much attention do you pay to the macroeconomic environment? And what's the flow-down effect to specific stock and commodity selection?
Do you want to have a crack at that one?
Yeah, understanding the macro probably takes up, as Sam said, around 70% of our time if we relate that to the investment process, because ultimately you can't outrun that. So we spend a vast amount of time reading around, whether it's general news articles, mining-specific news articles, talking to brokers, talking to companies, because if we don't understand what's going on the macro level, then it's very, very hard for an investment to work out. If we've got, for example, oil names, but the macro on oil at the moment is obviously pretty negative, it's hard to outrun that and provide upside to investors.
Very good. And with so many risks associated with investing in commodities, How do you avoid some of the pitfalls that are associated with exploration risk, for example?
Yeah, I mean, exploration's probably a little bit early stage for us. Like being a former geologist myself, I can say that the best exploration target you could dream of is at best a 50-50 bet. And that's not good enough for us. We need the odds to be more firmly in investors' favour. So the earliest stage we will go is to, where there's already an asset or a resource that's defined, and we can take a view on the economic viability of that resource, and we will run numbers to it the same way the companies themselves do. But I suppose in assessing the risks of at that point in time, I mean, we have a 15-year history and a very broad sort of basket or sort of a breadth of experience to assess the numbers that the companies themselves are saying that, this is what this deposit can be used for. And quite often you'll see numbers that are just simply unachievable. There might be a gold company that thinks they're going to process, their ore for $30 a tonne, whereas I know for a fact that, the cost is more like $50-$55 for the process that they're applying. So, we sense check those numbers. We take our own view on value based on those numbers, and then we match that up with the share price and see whether there's upside available for investors or not.
So let's get into some hot topics, right? And I guess one of them is the big focus on critical minerals and the role that they will play in decarbonisation. How's that energy transition progressing? I might ask you first, Ewan, and then if you've got anything to throw in, by all means, please do, Sam.
Yeah, I think the energy transition has definitely slowed down a bit from some of the euphoria you saw probably over the past couple of years. A lot of that was being driven by this push that we were suddenly going to get rid of fossil fuels. So that investment was going to go to zero. It was going to be sort of offshore, onshore wind, solar, storage state batteries. And then obviously the hydrogen push really came along. What we've seen is that's crashed into the wall of economics versus like the density of energy. And what we know from looking at this space for so long is you need cheap, reliable energy. And what you're struggling with the sort of energy transition side of things is that's not possible for those costs. I mean, hydrogen, for example, is still up at around $6 to $8 a kilo, whereas it needs to be down near $1 or $2 to start displacing some of those fossil fuels. What you're actually seeing happen now is sort of like the likes of copper, aluminium, the rare earths, still lithium, I think, will have its day in the sun again. Those metals are actually coming to the fore as their utility in the easier parts of the transition to come across, particularly, for example, like the AI data infrastructure centers. That's where we're seeing those metals come to the fore. And in reality, the likes of offshore and onshore wind, the economics don't match up. And so we're coming back towards the other metals that have traditionally existed.
Yeah, I mean, just to put some more granularity around that, and we're seeing this in Australia at the moment, where I think in the first half of the calendar year, there's been no large commercial wind or solar projects sanctioned. Plenty of battery projects, but no wind or solar. And that's very understandable because now, because these generation technologies have a capacity utilization of circa 25 to 30%, and that's sort of where we are at Australia in terms of the penetration of these. That means that roughly 30% of the time, wind and solar are producing 100% of the power that you need. And when they start producing beyond 100%, it pushes prices negative. So, when prices go negative every time the sun shines or the wind blows, it's very understandable that investors have gone, well, hang on, how are we going to make money from this if we keep on building some more of this stuff? And so that's why the government has to come in and sponsor the industry. But I think for retail, for consumers who might be trying to reconcile, well, hang on, if prices are negative, how come my power bill keeps on going up? It's because roughly 50% of your power bill goes to the poles and wires. And I'm not talking about the connection fee. I'm talking about the actual retail tariff, which here in Victoria I think is about 30 cents per kilowatt hour. Roughly half of that goes to the poles and wires. And so, as we have more people migrating to solar, which does reduce their costs, they're also contributing less to the poles and wires around the state. And those costs remain the same. So those costs get passed on to the remaining people that have to use the grid full time. So there's some very sort of fluid and complicated dynamics here that are slowing this transition down. But as Ewan said, the demand for power continues to grow. And I think we're starting to see a bit of a swing back towards dispatchable power generation and the value that adds to a economy.
And yeah, that's a great segue to my next question. So from a portfolio perspective, how do you go about balancing the portfolio between the old and the new drivers of commodity demand?
Yeah, it's a good question. I think more recently, we've probably swung back towards dispatchable power generation because we've had about 5 years, particularly since COVID, where there's been a massive build out of wind and solar, and the issues that have thrown up have only recently become apparent. So whilst wind, solar, and battery projects are still big consumers of lithium and copper and aluminium, more recently the gains in our portfolio, particularly Ewan's sleeve of the portfolio, have come from that dispatchable generation. I don't know if you want to add a bit to that.
Yeah, I mean, as Sam said, on the dispatchable side, we've had some good returns recently, and that's been driven by, I guess you want to say, the big four tech companies building out that AI infrastructure, and that CapEx spend has sort of gone exponentially up over the past year or so, where I think it's going to be just under 400 billion. But what they're using to power these energy-intensive data centers, where one AI rack uses the same power as 10 to 15 conventional data centers for cloud computing, they need gas power because the grid isn't set up. Batteries, solar, renewables do not offer the continuous or dispatchable power they need, and gas is filling that gap. Obviously, there's been a lot of news around sort of the nuclear deals being signed. Obviously, the restart of 3 Mile Island really kicked off, I guess you call that nuclear renaissance in the US. But ultimately, though, that ramp-up's going to be slow, and there's no new capacity coming on until 2030. What the US does have, with gas already the dominant generation power in the country, is an existing infrastructure, an abundance of supply due to the US shale revolution, and that's easily tappable for these data center operators. So we think that in reality, while US gas isn't maybe the best investment at the moment, where we've been playing it is via the gas turbine manufacturers, where GE Vernova and Siemens Energy in particular have done fantastically well, upgraded forecast twice this year, and we think there's more to come because ultimately that's a multi-year cycle. The backlog for new turbines is already 5 years and growing, and that's something we don't see changing anytime soon when that AI demand for cheap, reliable, dispatchable power is only going to continue to grow.
When we look at the current asset allocation of the fund, around 20% of the portfolio is currently allocated to gold. Now, with the incredible performance of gold in the recent times, with gold prices sitting at around $3,700 an ounce, do you still feel confident about this commodity? And what's your outlook?
Yeah, we do. I think that as we sit here today, gold's probably a little bit overbought. I think there's a lot of anticipation, I suppose, of rate cuts from the Fed, which we'll receive this evening. But I think gold remains on a rising tide, and that's because gold, it can be called a commodity, but I think it's more a financial instrument because it doesn't trade on supply and demand. Like all the gold ever mined is pretty much still around. It doesn't get consumed like oil or gas or copper. And the preference or the desirability of gold, I think, has really ticked up over the last few years for two reasons. First of all, it was after the US government froze the Russian holding of treasuries, and so they effectively weaponized their status as the reserve currency. And so all of a sudden, US treasuries sort of had a bit of risk around them, and they are meant to be the risk-free asset in the world at the moment. But the second factor, and I think this is becoming more front of mind over time, is the sustainability of the US government's debt. So, I think the cost of their interest payments has gone past their defense spend now. And on any projection, the US deficit is just getting bigger and bigger and bigger. And it's becoming more and more unsustainable, and more questions are being asked about this. So part of that driver of the outperformance of the gold price has been central banks moving away from storing their reserves in US treasuries and instead storing them in gold, like they did back in the 70s and early 80s. So until that outlook for the US fiscal balance improves, I think gold is going to remain on a rising tide.
Interesting. So there's a bit more to go in terms of the gold price.
I think so. Until the US can balance their books, or at least look like balancing their books, I think this, the way is up.
Very good. Now, talking on the US, how are you guys navigating the impact of the US tariff regime and, the impact on commodity prices?
Yeah, very interesting question. One that's come up a lot from investors. I think it's been a pretty volatile time because no one really understood the scope of the tariffs to begin with. There was a lot of speculation. In reality, we've seen it flip-flop around. I think you saw the aluminium tariffs got increased pretty substantially. And what was interesting there was you talked to sort of Alcoa, where 44%, I think, or 45% of their aluminium, of America's aluminium was being imported from Canada, and ultimately they're like, look, that's a pass-through for the customer. We're trying to redirect product elsewhere, and we've been successful in doing so because the aluminium market is tight. Demand has still stayed there. Growth in production hasn't come through post the shutting of smelters during COVID. So in reality, we're still going to benefit. And what you've seen is a rebalancing where previously that US Midwest premium was around 20 to 30 cents. Now it seems to have settled around 70, and that is where it looks like the normalized level is to sort of balance out that tariff impact, because ultimately the demand from US customers is still there for the primary aluminium. On the copper side, obviously there was a rush to try and take advantage of that arbitrage between the US and LME pricing. And then once again, as we saw with some of these other sectors, sort of Trump or the US government, however you want to put it, they backflipped, and sort of that primary product wasn't subject to the tariffs. It was the sort of end products, so like piping, sort of like insulated wire, where those end customers were feeling that pain. So that sort of arb pricing collapsed, but you've not seen that LME copper pricing fall much further because once again, demand has remained relatively strong. Inventory levels are sort of being measured in days rather than weeks or months. And you're seeing the supply side really struggle. There's been a raft of issues at large-scale mines over the course of this year. Like Grasberg is the latest one, where there's workers trapped in the world's second largest copper mine is sort of running at reduced production. Cobre Panama is still offline. And obviously we saw these sort of issues with the flooding due to seismic activity at Kamoa-Kakula. So I think while tariffs have been a struggle and we're constantly trying to wrap our head around what they mean, I think we try and come back to the fundamentals, which is what does demand look like? What does the supply side looks like? And then where do we think the best operators within that environment are?
So somewhat a multifaceted question, and just work with me here. Right? I think it's fair to say in the last decade that investor demands and allocation of capital has been very focused on tech. And in many ways, it's felt like commodities have have really not been in the line of sight of investors. But I feel like we're getting to a point now where and you touched on this, Ewan, but with data center and AI ambitions and the like, that we may be seeing a bottleneck to big tech's demand for specifically energy. So I guess the question I'm asking is there a sense that we could be perhaps at the start of a boom for energy demand?
Yeah, I think there's many different sort of factors at play here, but I think you've hit on an important one. Everybody is aware of the performance of big tech in the US. It's soaked up a huge amount of capital, a lot of which has migrated away from the commodity space, which sort of hit its zenith, in 2012 with the last commodities boom. But it's one thing to say, commodities relative to tech has massively underperformed, but so what? You need a catalyst to change that. Yep. And, as you rightly pointed out, I think we're at a stage now where commodities are sitting there as the bottleneck to big tech's ambitions for its data center growth and to pursue AI as quickly as possible. And big tech is very impatient and they are very well funded. So if commodity shortages are starting to get in their way, you will see capital starting to flow in the commodities direction from big tech. And that might even take the form of direct investment. Just recently we saw Apple underwrite a expansion of rare earths production in the US by setting a price of $110 a kilo, which at that time was about 100% higher than the rare earth price itself. So that is incentivizing, or that's the lengths that these companies can go to incentivize the supply of the commodities that they need. So it's a very interesting dynamic, but one that I think we're right at the beginning of. Yeah.
Ewan, anything to add?
Yeah, I completely agree with Sam in that on every metric, even before this sort of like AI explosion and the metals demand that's coming through from that, obviously the Russia-Ukraine war has then spurred on increased defense spending, particularly in Europe. Once again, very metals intensive. And suddenly you're looking at situations where, for example, on the EU defense side, that increase in copper is around 0.8% a year, which doesn't seem like much, but these markets are very tightly balanced, and a supply swing of 1% can push something into a deficit pretty easily. So you factor that in, you factor the growth of AI and their demands. And then in the background is sort of like the forgotten man of EVs. And everyone focuses, for example, on EVs and the lithium demand. But right now, that demand for copper is running about 1.2 million tons a year and is set to grow to 2.2 by 2030. So you add in then that on top of the copper needs from data centers, and suddenly you're looking at a situation where the supply side can really struggle to respond because you can't just turn on a large-scale copper mine to bring on 250, 300,000 tons in a heartbeat. And it's hard to see then how you don't have a situation where prices continue to grind higher.
Yeah, I was just going to add to that, just to bring like a US-centric conversation back to Australia. We had a catch-up with one of our companies called Southern Cross Electrical the other day. They're an electrical services provider to the mining industry, but also they build data centers as well. And they said, as they sit here today, their pipeline and visibility of work from data center construction feels exactly like it felt for iron ore construction in 2004. So the quantum and size of this opportunity should not be underestimated.
Yeah, right. Okay, so this is fascinating because demand supply, I guess, is at the core of the movement of commodity prices. So it sounds to me like we perhaps have deficits already. I don't know, you tell me, but if we don't, it's inevitable we're going to see deficits. So how does the supply side catch up? Can it catch up? And I know that's a broad question across all commodities. If you want to focus on energy or copper, you let me know. But am I right in saying that it feels like there's an inevitability, or if we're already at deficit?
I think we're certainly getting there. It takes time for these, you can take time for market participants to realise a deficit is in play and then adjust their behaviour accordingly. But when that behaviour changes, it changes across an entire industry. So you might have a commodity sort of ticking up in price, and all of a sudden people realise there's a shortage and they will try to restock immediately to get ahead of those shortages, and that brings forward demand, and you end up with a big spike in pricing as instead of being priced on sort of supply and demand, you adopt scarcity pricing, and that's when you get these really quite explosive moves, and that will happen at different points for different commodities. But to answer your question in terms of how does the supply side respond to that, the bigger the commodity is, the longer it takes. So for lithium, it took maybe 3 or 4 years, I suppose, for the industry to respond, because you were talking about a market that sort of grew from 300,000 tonnes to maybe 1.5 million tonnes today. Whereas back in the last boom, it took the best part of a decade for the iron ore industry to respond, to a market that was 600 million tonnes and grew to, maybe 1.2 billion tonnes. It took them a very long time because you need the ports, you need the rail, you need the infrastructure. It's much more complicated than just the mines. So for something like copper, that's a 26 million tonne per annum market. Once that goes into a structural deficit, it is going to take a lot longer to tip back into surplus, and so we should see the copper boom go for longer than the lithium one did, for example.
And then to piggyback on top of Sam's point, I mean, there's the actual mine production where the supply side's going to struggle to respond to some of these big swings that are coming. But then to bring it back to the energy side, you look at something like aluminium. Smelters, very, very intensive process. I think Tomago is still around 15% of New South Wales electricity demand. They've turned around the smelters globally and complained about the fact that, fine, there's issues with bauxite supply, aluminium refineries coming online, etc., but they can work through it to a degree. Their problem inherently is they can't get the cheap power. So if they need power at $40 a megawatt hour on a long-term contract, Teck, who's in demand and needs that power right now, is coming over the top of them going, well, we'll happily pay $100 a megawatt hour because it doesn't impact our margins in the same manner it does for an aluminium smelter. And I think that's where you're going to see this crunch where if Tech's prepared to pay over the odds for power, suddenly there's the potential for an entire industrial base to really struggle to catch up with that demand.
So while access to cheap and reliable energy is key to the ambitions of these large technology companies, what's your view on the wider energy market, and I guess more focus on oil and LNG?
Yeah, oil's an interesting one. Sort of been, I guess, the sick man of the commodity world this year. And to be honest, that comes down to the fact that you've got an abundance of supply. So Saudi Arabia, until pretty recently, was, let's say, producing around 8.5 to 9 million barrels a day. We know that sustainably they can do 10.5, more like 11. So straight away, you're set again, there's a surplus where you could turn on the taps and bring that production online. Obviously, OPEC Plus in general has been pretty aggressive with the quota system they've been running, trying to lift prices up. And that's because for a lot of these countries, they break even price to sort of balance their budget for sort of, supplying basic services to the population. It's probably higher than sort of like $80, $85, and it's got nowhere near that. The problem is demand also has been a little bit soft. So if you look at someone like China, China has accounted for well over half of the oil market growth over, I guess, say the last 10 to 15 years. China, though, is really aggressively pursuing a policy of sort of energy independence. So currently, a lot of their oil, a lot of their LNG comes through the Strait of Malacca. That's a risk for them, could easily be shut off. And instead, what you're seeing them push forward with is those oil imports have actually flattened over the past 3 or 4 years. Oil demand and usage within China has grown because they've been pushing domestic production. On top of that, they opened up the Power of Siberia pipeline with Russia. So that was like 38 BCM. And recently they signed another MOU for the Power of Siberia 2 for another 50. Now there's some tweaking around some of the existing pipelines coming directly into China from Russia. But suddenly you have a situation where that's around 50 million tons of LNG that China potentially doesn't need anymore. And so you've got that cut off from China on their sort of growth aspirations. You've got Qatar growing production from 77 million tons to 110, and then I think 126 via the North Field. And then in the background, you've got the US where they're going gangbusters and are targeting sort of 200 million tons of production. So ultimately, we're struggling to see where that scarcity is on the energy side of things. And I think oil, it feels like OPEC Plus having unwound 2 years worth of cuts are going, we're at the bottom end of the cost curve. Let's see how much pain you can wear. And on the LNG side as well, you've got players who their lifted cost of gas is so low that they can afford to flood the market and still make a decent return. So until we see that change, I think we're probably slightly negative on the energy markets at the moment.
Resource deals, merger and acquisition, equity partnerships, they seem to be back on the table. I don't know. You guys know better than me. So if that indeed is the case, which commodities do you guys believe perhaps are ripe for consolidation within, within sector participants? And perhaps I think you've touched on this, but I wouldn't mind going over it again. Why would this wave of deals be different, let's say, to past cycles?
I think the scars of the M&A that took place in the last commodity boom are still raw, amongst corporates and the investment community. And so, this time around, we've had the mantra of value over volume has been, adopted by the the large cap miners and the small cap miners as well. So, I think they're more wary about overpaying. But at this stage of the cycle, I think it's that M&A is probably still quite appealing, and it's being judged against developing greenfields projects, which are hideously expensive and difficult to do. There was a report out from some commodity consultants, I think it was late last year, that showed the permitting process to bring a new open pit copper mine into production is about 12 to 13 years. And that's after you found the thing in the first place. So for big mining companies that want to make a difference to their earnings per share, trying to build a big greenfields project is going to be, the benefits of that are going to be enjoyed by their kids. It's not going to be enjoyed by today's investors. And that's where M&A becomes much more appealing.
I think the reason it's slightly different, well, hopefully it'll be slightly different this cycle, is a lot of the big miners obviously blew themselves up with pretty aggressive large-scale M&A during the last cycle. And they sort of listened to investors and are focused on sort of repairing those balance sheets, hiving off non-core assets and focusing on their core competencies. You've got a situation now where if you look at the likes of BHP and Rio, their leverage is sort of well below 1 turn. Anglo and Teck, obviously that tie-up recently has been getting all the headlines, but both of them had approaches made for them over the past couple of years. So Glencore came for Teck just over 2 years ago, ended up taking the met coal business, and BHP obviously made a well-publicised tilt at Anglo and was unsuccessful. What you're going to see now, to Sam's point around that capital intensity, is if you're someone like BHP, you're thinking what commodities make sense for a miner of our scale? Copper's the answer. And it's better to buy a producing asset than go through the pain of trying to get permitting, development, the capital intensity, all those sort of things, I think, which will bog you down. And in the meantime, you'll get hammered by shareholders who've still got memories of what happened last time you went ahead and sort of leveraged the balance sheet up. So I think that's where the difference is coming through. And in turn, you're seeing shareholders are receptive of this because ultimately it's resources. These are depleting assets. And while as shareholders, it's great to get special buybacks and increase dividends, ultimately, I need to see a long-term vision for how you're going to maintain and grow that asset base.
We're nearly out of time. Just a couple more questions. It maybe I could use copper as an example if you don't mind. So when you're structuring the portfolio, and let's say if you're positive on copper, how do you then get your exposure? How do you balance buying, let's say, the physical commodity as opposed to buying a miner? And can you buy a miner like BHP where it does do some copper but does other things as well? Or is your preference specifically to buy into a miner that does copper only? So how do you balance all of that up?
Yeah, it's a good question. And I'll answer the second part first. And that is that we prefer to construct our commodity exposures ourselves. So across the portfolio, our preference is for pure play miners, and then we can mix and match to build our own commodity exposures across the portfolio. But as far as I suppose, Ewan, do you want to have a chat of the second part of the question?
Yeah, sure. I mean, it's an interesting question when our preference is obviously for Australian listed names because that's most advantageous for us. But when you're looking for a commodity-specific stock, especially on the large cap side, copper's a prime example of where it's hard. In that universe, it's probably only Sandfire, excellent company, but there are better options offshore in terms of the operational growth, returns, stock-specific catalysts as well. And that's where, for example, we'll look at someone like Teck or Capstone Copper as that optionality for ourselves there.
And buy the physical as well?
Well, yeah. And to round that out, like because we have the option of buying the physical, that sort of sets a higher bar of the risk and reward balance that we require to buy an equity. And if we can't find an equity that offers a better risk and reward, opportunity than the physical, then we'll just buy the physical, which doesn't have any of the operational risk, governance risk, balance sheet risks, weather events with things going wrong, and we'll stick with that. So it's I think it sets the bar higher for the equities that manage to get into the portfolio.
Thank you, guys. One last question. This fund has been running for a bit over 5 years now, with inception in April 2020. You've achieved outstanding returns over this period. Can you reflect on this period? And I guess most importantly, are you happy with the results that you've achieved?
Yeah, I mean, if I knew 5 years ago that we were going to be sitting here with a since inception return of 29%, then I would have taken that in a heartbeat. And there's always a little bit of luck involved in investing, and we need to acknowledge that. But we're the whole purpose of this trust is to reduce that volatility for investors. We're very cognizant of preserving capital and not having any big drawdowns, and that in the end, I think, has managed to support those returns through the cycle. Because when commodities are running hot, it's not difficult to make money out of them. You can sort of throw a dart at a board and they'll all go up. The hard part is sort of navigating the portfolio through those tougher periods and making sure you preserve, investors' capital as well as our own capital, which is invested in the fund. So, that's the key to it. But yeah, to your question, I'm very happy with the way it's going, and may long it continue.
Thank you, guys. You're right, Sam. You do need a little bit of luck when you're investing, but it also takes great skill to produce the results that you have. So on behalf of our clients and on behalf of Amelia and I, thank you for your time today, both of you, Sam and Ewan. And yeah, all the best of luck, dare I say, going forward. But we have great confidence in what you're doing. So thanks for your time today.
Absolute pleasure. Thank you.
Thank you very much. Appreciate it.